You're watching Startup Central with me, Naintara Rai. This is the only show of its kind on Indian television dedicated, of course, to startups, innovation, technology, disruption, entrepreneurship. Basically, if it falls under the gambit of the new economy, it's going to be here every weekday at 6 p.m. Now, there's a very interesting report that has come out by InnoVen Capital, and it's the Outlook report for 2021. We're featuring this report because of so many interesting things that this report actually shows up. So let's get straight down to it and discuss all the interesting things with the CEO of InnoVen Capital, Ashish Sharma. Ashish, thanks so much for joining us here. My first question to you is, and it's a report that went online today, which says 77% founders ranked growth over profitability as a priority for this year. 42% plan to be EBITDA positive in 2 years' time. And 47% of the founders believe the IPO is a realistic exit scenario. When I read all this, the first thing I thought was, the startup ecosystem has come of age. Look how it's matured.
Yeah, thanks for having me. And, I do fully agree that the startup ecosystem has come out of the pandemic, the temporary dislocation that happened through COVID with the banks. So right now, if you ask investors, if you ask founders, the mood is very upbeat. The sentiment is at all-time high. And frankly, it did surprise me a bit as well, given that, during COVID, the standard playbook was cutting cost, trying to increase runway, and essentially, just hunkering down. But over the last 3-4 months of 2020, I think demand came back, unit economics improved, investor sentiment went up. So as we get into 2021, clearly, the venture ecosystem is on a sound footing.
Now in the report, I also see that EdTech is the most hyped up sector. But in 2020, to be fair, it was a necessity, right? That's how children studied, working professionals upscale. But now with the vaccine program underway, there's all this talk of hybrid models. So much ground that still needs to be covered, and your report says it's hyped up.
That actually did not surprise me because if you remember, there were only a couple of sectors that saw tailwinds immediately after COVID. And by far, the number one was EdTech, followed by maybe gaming. Essentially, there's a lot of money that has gone into EdTech. There's a lot of consolidation that has happened. So I think fellow founders believe that right now, I think investors are going head over heels to put money in EdTech. In their mind, the sector is a bit overhyped. Having said that, there are clearly 3 or 4 players, that have gained immensely during COVID in terms of signing on new subscribers. There's at least one company that which probably has a credible path towards the public markets over the next 18 to 24 months. So yes, it is definitely overhyped, but the business is on a very strong footing as well.
The report also shows that logistics is the most underhyped sector. What exactly does that mean? And is this a space where we like to see a lot of deal activity?
See, logistics, you have to look at what part of logistics. So if you look at logistics that is actually, inclined with e-commerce, that is experiencing a lot of tailwinds, particularly, at the onset of the festive season in September. So, and we have a bunch of portfolio companies as well, and all of those companies are obviously riding on the e-commerce wave because e-commerce has clearly been one of the very strong sectors after COVID. But if you look at long-haul logistics, that largely caters to non-e-commerce, I think that sector has seen, a lot of challenge, and the challenge has been on 2 or 3 fronts. One, the demand hasn't fully come back. The second is the margins have gone down because of, continuous fuel price hikes, which, most of these players have not been able to pass on. And the third part is, I mean, there has been, a lot of challenges in the quality of debtors because these players were serving to the, not the startup economy, but the general economy, and certain sectors of those economies still continue to remain challenged. So collections and recoveries, that has been a challenge as well. But again, as I said, if you look at express logistics, which is linked to e-commerce, that part of the business has been very, very robust.
So, what are the sectors that are looking hot for 2021? What looks hot is being called overhyped. The other ones are, of course, being called underhyped. So what's hot? What's realistic? And, I want to put this in context. This is all your report is only based on your conversation with founders, right? So that's one perspective.
So yes, so this survey is largely focused on 100 high quality founders, largely institutionally funded. So all the findings are their perception and what they believe in. So coming back to other sectors that are experiencing, I would say smart recovery, I would definitely pick anything that's related to deliveries. Things like even, furniture, online furniture. We have a portfolio company called Pepperfry that's been experiencing, a lot of tailwind. B2B platforms have also been very strong. So I'm talking about not enterprise software, but B2B platforms which are focused on niche areas, whether be it into engineering or, industrial supplies. And that's largely driven because, COVID has clearly created challenges with the old type of supply chain. The third one that comes to my mind is enterprise software. Again, this sector did see some challenges in the first few months of COVID, but there is, very strong, emergence of business moving to these new age digital kind of models. Plus, there's been a lot of investor interest in this space as well. So I would say, overall, if you look at our survey, almost 2/3 of founders, were already ahead of their pre-COVID revenue run rate. And this was, when I mentioned December, if you were to look at real time today, sitting in February, my sense is probably 90% of companies are ahead of their pre-COVID run rate. There are a couple of sectors that continue to stay challenged, which are largely travel and hospitality, and I would say parts of mobility. But overall, most folks are neutral to positive, at this stage.
Something else that I found in your report, which I would like to discuss with you, 52% say the biggest challenge is hiring good people. Is there really a dearth of good talent for new age companies? We hear so much about jobs, and here startups saying we can't find good talent.
Well, it's not about the ability to hire, but compared to conventional companies, the pace of growth, which means the pace of hiring, has to be at a very different level. So literally, all of these companies, at least high quality companies, they're going 120 miles an hour, which means, if you did revenues of X today, you're targeting 3X the next year. So the challenge for them has been, how do you keep a high quality, consistent flow of talent to your organization while making sure that, people you bring in, they resonate with the culture that you're trying to build. And, in some cases when companies maybe go sideways and some of the employees might think this is not, a ticket to a rocket ship, you also got to manage attrition. So the challenge has not been about hiring people. I think it's just, how to hire fast while maintaining consistency of, quality.
Let's talk about exits. Your report says that the majority of those polled, more than 40%, actually prefer exit, and we are looking at IPOs as the exit. I want to talk to you more about that. 30% say IPO in India. You've got another 17% talking about IPO offshore. This also, of course, shows maturity, but I found it particularly interesting that the lion's share, 30%, wants to IPO in India?
I think, see, again, the question that we asked was we split into IPO, both domestic as well as international IPOs. So this covers both. I think the interesting thing that stands out to me is, I mean, every year we have been hearing that founders would like to do the IPO in the next couple of years, and in my mind, there is nothing that would be more healthy for this ecosystem, but to have some great public companies out there, in the new age economy, like what we see in China, or for that matter, in the Valley. So while for the last 3 or 4 years, I mean, a lot of people have expressed their willingness to do an IPO, I don't think so they were ready. I mean, this time to me, it feels like it's for real. There are at least 15 to 20 companies that we are tracking that we believe have a credible path to public markets. A lot of them are looking at domestic listing, some of them are looking at overseas listing. So that clearly is a very positive development for the ecosystem. We would love to see some companies go public and stand the scrutiny of quarter in, month in, quarter in kind of analyst scrutiny, and build sustainable businesses.
But what I also found was that fintech is looking primarily at secondary share sale exits, and fintech and travel hospitality being more open to M&A buyouts. Why the special mention in the report, and what's so special about these two sectors that they stand out with a different kind of exit that they'll prefer?
I mean, so there are 2-3 things that come to my mind. One is, the M&A is generally preferred in sectors where essentially there are a lot of large players. So when you look at fintech, right? I mean, fintech is the biggest profit pool in any economy that you go. And even the largest fintech player in India, if you leave apart payments, would not be among the top 20 people. So eventually in a space where there are a lot of large incumbents who are looking to add new business lines, or looking for talent or new business models, there's always opportunities for buyouts and M&A. So that's one thing that comes to my mind when I look at travel and hospitality. I think one of the reasons is, this space has been in a tough neighborhood, right? So, as they say, you can have the best house in a tough neighborhood, but still it's a tough neighborhood. So, this space, I don't believe there's anybody, except Airbnb, which obviously did a bumper listing, but that's a totally different business from a size and profitability standpoint. So I think in this space, public market aspiration is still several years away, and it would take recovery. So probably that's what drove some of the founders in this space to think about secondaries as the best course of exit to some of their investors in the future.
73% founders want professional CEOs. Do you really see this happening? We've seen it in the West, whether it's Google or Microsoft and LinkedIn, Uber, etc. You see it happening in India?
I think that's, again, very interesting. This is a question that, if before looking at the results, I would have probably thought very few founders would be open to professional CEOs coming and running their baby, right? I think we are now starting to see a number of examples where that is happening. I can give you a couple of examples right from my portfolio. So you may know this company, Daily Hunt, right? So if you look at Daily Hunt, Viru, built a great business, and a couple of years back, Umang from Facebook, who is now a co-founder, came in, and I think both of them are doing a great job in terms of taking the company to the next level, and a very good kind of a working relationship and chemistry. The second one that comes to my mind is a company called Boat, which is into accessories, largely on the audio side, where, again, here recently, just I think a couple of days back, they announced that, Vivek, who used to be Godrej Consumer CEO is going to take over as the CEO, while the founders obviously will continue to stay involved, but they will have a professional CEO come in. Another one that comes to my mind, which again is not my portfolio company, but I know them well, is Policy Bazaar, where, Sarabveer, I think 6 or 9 months back, he took over as the CEO. So I think we are starting to see some of that trend in India. It's still very early, but to me, this signifies the maturity of the ecosystem. Because frankly, it's not about that for every company, this is the right solution, but for certain companies at the right level of maturity, and when it is really driven by the founders and not driven by the investors, personally, I believe it's a positive development in the ecosystem.
I've saved what I would like to call the best for the last, which is an insight into what it is that the startup founders admire these days. They admire Zerodha and Nikhil Kamath the most when it comes to founders, and of course Elon Musk globally. Interesting insights.
Well, you see, this is a question. This is a sixth edition of the survey. So somehow Elon Musk has been there. I mean, he has that kind of a cult status. When we ask founders about the global, the global founder they admire the most, in India we have had different founders being identified and different companies. I think this year founders chose Zerodha and Nitin Kamath because it's a very special kind of a company, right? I mean, it's a company that really hasn't raised any institutional capital, so has been profitable. Came out in a space where incumbents, were running a business in a similar way over the last 50 years, probably. So has totally kind of disrupted the space. So I think those are some of the reasons why, fellow founders chose Zerodha and Nitin.
On this edition of Startup Central. Look forward to more interviews. With that, ladies and gentlemen, we're going to take a short commercial break. Coming up on the other side, it's a startup that's in the fintech space and it's got a check from Sanjay Nair and Falguni Nair, the Nair family office. Who's that startup? Why are we featuring them? How did they get the check from Sanjay and Falguni Nair? Stay tuned to find out.